Good afternoon and welcome to this final presentation here at ABG Sundal Collier Investor Days. My name is Simon Granat and I work as an equity analyst at ABG covering technology and IT companies. And with us today we have the pleasure of welcoming Henrik Molin, who is the CEO of Physitrack, and he will for the coming 20 minutes present the company and give us an update on recent happenings, and then we will follow up with a smaller Q&A session. So with that said, Henrik, please go ahead and present.
Thank you, Simon. Saving the best for last, obviously. Don't let me stand in the way of the after work drinks. So let's kick this off. Let's go forward 2 slides, please. Simon. I am, as Simon said, I'm the CEO and co-founder of Physitrack. We are listed on Nasdaq First North Premier. Our ticker is PTRK. I'll give you a little introduction to the company and what we're up to. I'll talk a little bit about the strategy and outlook. I'll touch a little bit on what's going on in this type of market environment and this type of macro environment that can be challenging for a lot of companies. And I'm happy to say that it's almost the opposite for us in terms of what our business is based on, but I'll get to that in a moment, and then we'll open up for some questions. So let's go to the next slide. So Physitrack, we have 2 sides of the business, so 2 divisions. If you look there on the left side, that's the business that I co-founded with Nathan Skvortsov, my close friend, back in 2012. We call that life care technology. It's technology that we put in the hands of healthcare providers around the world so that they can feel to make their patients and or whatever employees perhaps feel better and happier. They go through recovery and we support them throughout that recovery with the tools that we sell to our healthcare provider customers. That's about 75% of the business. And I should say right now, our turnover on a run rate business is about 12.2 million euros, or roughly 125, 130 million Swedish krona, depending on what mood the Swedish krona versus the euro is in on that day. Now, on the right side, we have our virtual wellness division, which is a relatively new addition to the group. We started working on the wellness division in 2021, and this is something which we have come into via acquisitions, but acquisitions that have been integrated into the group and supported by technology that we have developed. And so we take a tactical and strategic view on our acquisitions, and we make sure that we have great organic growth after our companies join the group, which is very, very important. So not a buy and hold, and I'll talk to you a little bit more about that. But overall, a very nicely diversified portfolio. And let's go to the next slide here, Simon. And on a geographical perspective, we are all over the world. Our life care technology is available in 15 languages, and we have customers in a wide-ranging geographies from Australia to the US, and a lot of activity we have in Europe. So the heart of the business is in the UK and in the Netherlands and the Nordics, and a lot of the application development and the tools that we produce are made there. But it's a truly diversified picture here, which means that we're not really vulnerable to any specific geos. We're not really vulnerable to any specific customers. It's a very diversified portfolio. And that gives you a little bit of a hint as to how a company like ours can be very robust, even if the outside world is a little bit turbulent. Let's go to the next slide. This is from our last quarterly report, and this is pretty typical of us. We've reported 6 times now as a publicly listed company. We have met or exceeded market expectations and delivered what we promised, which in this day and age is not something that's always the case, especially with newly listed companies. But I'm happy to say that this is really at the heart of where we are. We like to deliver on our promises. We like to achieve numbers and KPIs that we have expressed as being target numbers and KPIs externally. And so this is a typical example. Our reporting structure is quite nice when you look at this, but this gives you a little bit of a hint as to where we are. And our target with the business is to grow 30% organically year over year. And this is something that we've consistently clocked in at as a listed company. Obviously, in the past, it's been more, which we will illustrate with the next slide there, Simon. So this is the journey, and so as you can see there, somewhere in the middle there, you have organic revenue, CAGR 89%, and so this is something that we're very proud of having achieved, and we're very focused on growing with little external capital. So over the years, we have grown as a bootstrap business. We had some shortcuts for us that helped us with that. If you look at the left there, there's a little Apple symbol. We were part of Apple's accelerator program for iPad apps back in the early days, back in 2015. We found product market fit in quite an extreme way thanks to that, and that enabled us to actually grow with just our own money. So it was my co-founders' money originally, and friends and family along the way. We never really raised money externally until we IPO'd the business in 2021. So this is how we intend to continue running things. Nice growth organically, and also acquisition growth. If you look there on the right side, you can see that we added a whole wellness division, which is now 3.4 million, and this is something that's expected to grow quite dramatically over the next few years, because the market drivers for these are really interesting. So let's go to the next slide, Simon, and let's take a little look at the two different divisions. And I'm going to talk to you a little bit about the life care division and the tools that we have at our disposal there. So I used diversified when I spoke about the revenue streams. So diversified in terms of geography and the different language versions, in terms of the customer base, not relying on having customers that dominate your book of business so much that if you lose them, you have a big problem. So we're very much the opposite. We're very diversified. And so we're a software as a service company. We sell our software to businesses. Life care, we sell to care businesses. So care providers use these tools to help their patients feel better, faster, and in a more highly qualitative way. The heart of this business is the second box from the left, which is the Physitrack and PhysioTools platforms. They are subscription services where you get access to clinical content that you use with your patients in between appointments. So if you've been to a physiotherapist, you've been to a chiropractor, you've done some sort of treatment, you usually get some tools and some homework to do in between appointments. That's the heart of our business. The biggest exercise library in the world, 15,000 clinical exercises that are available as a subscription service for quite a small price. And the reason why we do this is because we like a widely diversified book of business, but also we open up the door to have more tools for our customers. And so if you look at the screen here, you have 5 different boxes, and this is how we operate. We make sure that we cater to the needs of our customers, whether they're small to mid-size, and perhaps just pay if there's just one guy, they might pay just 10 euros a month to get access to our exercise library. But if they're a big enterprise, they might need telehealth messaging. They might need outcomes analysis and statistical tools to help them understand their rehab businesses. And we also white label. We deliver custom apps to some of our best customers, and that's a business line that's gone really well. So this business doesn't really rely on the whole user ecosystem growing over time. Of course it does. We have really nice strong growth in the underlying user ecosystem, but once people are part of that ecosystem, there's a lot we can do with them with a diversified set of tools, which makes this into a very robust business. Let's go to the next slide. I'm not going to dig into this too much because we have a limited amount of time, but the way that this stuff works is that a healthcare provider usually signs up to our system. They can do that in a fully automated process, going online, paying with a credit card. We have some great automated tools to onboard and support and take care of our customers so that they remain in place for as long as possible. So that's the box, second box from the left up there. The journey with the patient is quite dynamic. It's based on some nicely designed apps that Apple helped us with once upon a time. You can use these things as well in very old school ways, printing or just on a website, and your old granny's iPad will work perfectly well with this stuff. So we try to find sort of the flavor of what our customers' patients need. And if you do these things in a more advanced way, you can look at the bottom box on the right there. We can use statistics and things like that to help our customers understand what they do. So bigger customers, bigger healthcare systems in the public space, so public healthcare, or the big hospital clinics in the US, for example, example, they like to know a little bit more what goes on inside of their ecosystems, which can contain thousands of users, and they can have hundreds of thousands of patients per year. The white labeling is illustrated at top right. So nicely diversified, nicely thought through to be a robust business, and that doesn't suffer too much if there are changes in the outside world or in the customer base. More on that in a moment. Let's go to the next slide. Now, wellness. This is the new division, 3.4 million euros in turnover, which were built up in a relatively short period of time. We're talking about a year and a half that we're going from nothing into that type of size. The big reason for our wanting to go in there is illustrated here. And we obviously have really big ambitions in terms of our whole business. We like to elevate the world's well-being, which you saw as our mission statement, which you had on the first page there of the presentation. And now, if you want to do this properly, you have to go down the path of prevention and wellness and taking care of individuals, and not just when they go through rehabilitation or they have an injury. You need to preemptively take care of them so they can feel better in the context of their everyday lives, which is why we sell tools into companies so they can take care of their employees. Let's go to the next slide. So this is the star of the wellness show. This is Champion Health. Champion Health uses algorithms to understand what an employee goes through in their working lives, and a little bit of a sprinkle of what they go through in their personal lives as well. What stress factors they're subjected to, how they live their everyday lives, and how that makes them feel at the end of the day. An employer would invest in Champion Health to understand what their employees need to be healthier, happier, more productive, etc. And an employee has a fantastic tool to learn more about their individual drivers and what they need to focus on to feel better and be happier and be more productive and things like that. So it's a very individual journey, and this is something that's put together by algorithms so similar to Netflix. This is something that picks up world leading in terms of quality, in terms of scope, videos and educational material from our proprietary database, and it provides that in a steady stream to employees, just like Netflix would, but in an automated fashion. So, and if you look there on the bottom right there, you have everything that you need to understand yourself. And there's a flip side to that for an employer where they, on an anonymized basis, can understand exactly what goes on inside of their employee ecosystem. Very, very powerful platform. Let's go to the next slide here. Now, the beauty of this stuff is not just the algorithm-based drip feeding of educational material and contents and things that you need to know to feel better and happier and all that. It's the fact that we've actually opened this up. And this is why we came into this through acquisitions. We wanted a holistic, a full coverage ecosystem with all the different components that you might need on a day-to-day basis as an employee to feel better. And we wanted a tool that that employer could trust to just take care of their employees. And so we have a really, really nice set of tools here. Similar, we like the diversified situation. Compare this to the life care slide that I show you. Same thought here. We make sure that we have something that can really provide a powerful, holistic experience, whether it is this Netflix for well-being or what can be used to actually get care on an emotional well-being, mental health level, or on a physical level with access to physiotherapy, for example, online physiotherapy. So that makes the whole thing come together very, very nicely with great tech and also the care provision that we've acquired our way into in the last year and a half. Let's go to the next slide. Just as an illustration of this stuff. So you want that seamless experience. And if you see that the line on the second row there on the left, private medical insurance. So this, you can see this as a medical insurance light without the financial burden of being an insurance company, but it's something to be there as the first line of defense for your employees to make sure that you take care of them in stressful times. And over time, what you will see more of these components being integrated into Champion Health to provide eventually the most powerful holistic employee wellness solution in the market. And we want a single point of access for this, and we want tailored content with those algorithms. And it's something that's going to be a very, very nice and powerful product. It's a very fast-growing business already. Champion Health, since we acquired them, that pretty much doubled in terms of the run rate. In terms of all the care businesses that we have, they've done extremely well in this climate. A little bit more. I have one last slide here, Simon, if we just switch to the last one here. We did launch access to physiotherapy. So if the algorithms tell you that, you know what, your body is starting to be a little bit too much in pain for comfort, you have access through Champion, the ability to do online physiotherapy and also hands-on physiotherapy, because we actually have a network of clinics available to users of Champion Health in the UK market. So these are some very, very important pieces of the puzzle, and not just for Physitrack's business as it is, but also if you look at the macro climate as we experience it right now, there's a lot of things going on that are putting humans, employees, or patients under a lot of pressure right now, because the world is a stressful place. The macro environment is the most unusual macro environment, at least that I've seen since I was born about 4 decades ago. And people need these tools. And this is why this is a very, very interesting commercial situation for the Physitrack Group in general, and also for Champion Health in particular. So when we look at the macro environment, and we can go to the next slide, Simon. If you can look at the underlying market growth dynamics, we are definitely in a situation which is supporting the revenue generating situation of our group, of our business. There's some extreme movements there on the macro side when you look at inflation and you look at what it's doing to people, their consumption patterns, and what it's doing to their interest rates on their mortgages. It's putting a lot of pressure and a lot of stress on people, and this is where we can come in and help. So it feels really good to be that provider that can actually do that can come in and help. And of course, the secondary effect of that is the fact that it creates a very robust, nicely growing business, because these are prioritized areas for companies. In an inflationary environment, when you have so many macro challenges, your employees will need help. And the help that they need is probably not going to be in the form of raised salaries. That will help a little bit, but in the long term, what they need are tools so that they can take care of their emotional well-being and their physical well-being, and to sort of have the ways to deal with this on a daily basis. And so there are a lot of investments going into that right now. We're seeing some very big and some medium-sized and small companies moving down the path of investing in Champion Health. Very, very powerful. And as well, on the life care side of Physitrack, there are a lot of things that are happening as well because of the stressful environment. There are a lot of injuries, there are a lot of surgeries, there are a lot of things going on that are supporting the growth of that technology. So on a top line revenue growth situation for us, we are very much favored by this macro environment. And so on the left side, the market growth dynamics, that we are very much in that macro tailwind situation. Of course, you still see digitization, etc., going on, but it's very, very evident right now that we're in the right space here. And then if you look on the right side, the M&A initiatives, we are consistently and constantly looking at new opportunities to invest. We are keeping a bit of a lower profile now than we have previously, because we want to guard our cash, we want to guard our profitability. Care businesses, by definition, are a little bit less profitable than what we see on the Physitrack side of things. If you go to the next slide, Simon, just that's my final slide before we open up for questions. Now, if you look at the middle, the profit margins, now, historically, Physitrack, the life care business, has clocked in at over 50% of margins, so EBITDA margins, and this is where we are going as a group. But when you first acquire care businesses, they usually come in at a lower margin, and you have to work organically just to raise those by looking at synergies, by looking at injecting great technology, and by accelerating top revenue with higher margin products. But we are definitely in the most buoyant environment that I've ever seen for our business, and it's very, very exciting to be part of that. And that was a little bit longer than the 15-16 minutes I had planned, but I'm happy to go to the Q&A now segment if you have any questions for me.
Thank you so much, Henrik. Certainly lots of exciting stuff happening, so thank you for that presentation. Moving into Q&A, while you are quite diversified geographically, what key markets would you say are highlighted in order for you to sustain your rapid organic growth here going forward?
So our core markets when it comes to Champion Health are the UK, the Nordics, and Germany. The UK is growing extremely rapidly, and I think it's just the beginning. So as I said, Champion Health has more or less doubled since we acquired them in the beginning of May. Super exciting to be part of that. The German side of Champion Health has actually grown. If you look at it on a year-on-year basis, that's in the Q2 report, that's actually grown 1,200%. But if you look at this year alone, we're up something like 400% on that business. Super buoyant, super fast growing. So these are definitely target geos that are highly prioritized. And when you look at the Physitrack or sort of the life care side of things, we see growth in the usual suspect markets, and the strongest one actually for life care is the US market for us. That's where the needle moves the fastest, but we are present in a lot of places. Australia is still going strong, and after all these years, that was the first English market that we launched into UK as well. A lot of stuff going on in public healthcare, etc. But really the major growth here on Champion, that's important, that remains those three key markets, and that's where we'll see the most action going forward, and to the tune of several 100% in those underlying businesses, which is extremely fun to be part of.
I can only imagine, and we touched a little bit on the inflationary topic during the presentation, and we have current levels that hasn't been seen for a long time. How do you adapt pricing in relation to the current environment, and are you receiving any pushbacks or anything similar from customers?
So pricing power is something that comes up as your magic Harry Potter wand these days. If you have pricing power, you're usually robust in inflationary environments, and you see that with bigger SaaS businesses, or Microsoft is a perfect example, and others, where you can actually raise prices and customers do absorb that. On the Physitrack side, that's not an exception. We are a core product for our care providers on the life care side of things, and so we have consistently raised prices over the last 3 years. We have been artificially cheap, in my view. I think we have not charged the amount of money that this technology deserves, I think, in a lot of markets, and our customers understand that. So we sort of double up on that price, the price sensitivity or the lack of price sensitivity, in the fact that this is a core tool, day-to-day tool that's very important. Plus, it was underpriced. Champion is relatively new for us, and so we haven't adjusted pricing there. But I wouldn't be surprised if you have a really nice price elasticity momentum in that business as well, because it is very important that this is a very important tool for taking care of your employees. So we'll see down the line. Right now, we're just in the middle of the market expansion, and so we don't see any need to adjust those prices. In terms of inflation for us and our sensitivity there, so I'm guessing that's could be a follow-up question. Now we are lucky that we are grandfathered in a lot of the ways that we acquire or we buy technology from third parties, and so we subscribe to SaaS tools at our end to make sure our platform runs. And so we've seen price raises for stuff like Slack. We've seen price raises for some of the components in the platform. But actually, I think that because the tech market has been under so much pressure from a capital raising point of view, the big providers like Amazon Web Services and other big guys, they have actually not raised prices because they know just how sensitive this is right now for tech companies. So I think we're quite spared there. And lastly, in terms of our staff and our teams, well, the biggest addition that we had to our team was a development team that we built. We replaced an outside developer with we're just building our own team. And so the biggest hiring spree that we've ever done internally since inception, we're talking about a team that's close to 20 people today. It's actually done quite recently. And so it has all of these sort of the new pricing in place in terms of salaries. And so long story short, there's not really any cost challenges up ahead, we think, because of inflation. We like to be opportunistic so we can invest in things and people, and we want to grow, but that's a different story. So we've actually communicated that we think that we're in a good place to have around a 30% EBITDA margin right now, with the target of raising that to 40 to 45 in the next couple of years. But right now, this is a great environment to invest into, to acquire people and components and tech and all that stuff to just support growth. So if you see lower margins at our place, around the 30% mark, which is where we clocked in the last, the last 5 quarters, last 6 reports, is perfectly normal with being opportunistic. And but overall, I think we're in a really good shape.
Great, and as you pointed out, you also answered some of my follow-up questions, but I have more, and you also touched upon one subject in the latter part of your answer there, and that was relating to your margins, and your entrance into virtual care seemed to be weighing a little bit on margin, but it seems to be growing quite nicely. What would be the main hurdles in order for you to achieve your 40% EBITDA margin target, and what effect does virtual care have on improved sales?
So I'll flip that around. The main tool that we have to expand margins is to focus on higher margin products. And so a big part of the existing business that we had with these care providers as we acquired them were lower margin products, because they had a certain element of virtual care in it, but they also had an element of physical care in them. And the combination that they had when we incepted with them as part of the group were that they needed a tilt further into virtual. And the good news is that with Champion Health and also with the collaboration with Nightingale, it's creating some really, really nice market expansion dynamics that's based on revenue. So revenue composition in terms of the products that you sell and develop, etc. The margin expansion is less evident in terms of cost savings. You do have certain overlaps when you acquire a company, but in fact, on the wellness side, most of what we focused was really acceleration, and that's what's driving margins to go wider for us. And so I think that's a healthy dynamic, because the last thing you want to do when you acquire somebody is to start cutting costs and people. That's usually quite demotivating, and so we've actually focused the firepower on looking at the product mix, and that's the number one tool for us to make things happen.
Okay, thank you so much for that answer as well. As we are running out of time, I'd like to ask you if you have any final remarks to us that you feel that you wish to highlight that we haven't addressed already.
Listen, I think if there's an all-weather play in the digital health market, meaning something that has robust revenue streams, nice growth, and a predictable future in terms of margin and success, it is us. I don't want to do too much advertising and toot my own horn, but the way that we have composed our book of business, the way that we think about the market dynamics, and the way that the macro environment is playing into what we do, regardless if the market is difficult or if it's really easy, it is really proven to be a very, very robust strategy. And I think you've seen that in the numbers as well over the last 5 quarters with 6 reports. And if there's anything I want to say, it is really we're sticking to our guns, and there's no plan to change that anytime soon.
The future certainly looks exciting. Thank you so much for attending here today, Henrik, and I wish you a great rest of the day.
My pleasure. Thank you.